Welcome to Wealthy Behavior, talking money and wealth with Heritage Financial, the podcast that digs into the topics, strategies, and behaviors that help busy and successful people build and protect their personal wealth. I'm your host, Sammy Azuz, the president and CEO of Heritage Financial, a Boston-based wealth management firm working with high net worth families across the country for longer than 25 years. Now let's talk about the wealthy behaviors that are key to a rich life. Welcome to the December investment edition of the Wealthy Behavior Podcast, where I talk to our Chief Investment Officer, Bob Weiss, about what's going on in the markets and the investment universe that you need to know right now. So, Bob, markets have been pretty happy. I would say the month of November was really good for stocks. As you know, I think it turned out to be one of the best months in history, and bonds performed well as yields back down. So people looking at their portfolios now are probably seeing a little bit of a higher return than they might have expected if they had only checked it, a couple months ago. Anything that you've noticed outside of the yields coming down, which helped the bond market and may have helped stocks, that kind of drove this November rally?
Yeah, I think the headline that summarizes it well is November was the best month for a 60-40, 60 stock, 40 bond portfolio since 1991. And that's if the 60 is measured by the MSCI All Country World Index, so global stocks. US stocks did well, global stocks did well. And I think it gets summarized in it's not good or bad, it's better or worse, kind of a theme that we've had along the course of this year, and things are getting better. So that's what propelled the rally for the most part. And by that, it was good inflation data. So the PCE, which is the Fed's preferred measure for inflation, came in at the headline number, so all-inclusive, 3% over the last 12 months. And for the month of October, 0%. So no inflation in the month of October. And the core PCE, which excludes food and energy, which are more volatile, as we've talked about oil prices going up, and then oil came down 3.5% over the last 12 months. So a good number, and it's trending in the right direction. We did have a point around the summer where inflation got a little sticky, and we had this nice downward trajectory from peaking at 9, and then we got stuck in the 3 to 4% range. And just reference the CPI numbers, also 0 for October and 3.2% year over year. So on the whole, these were better than expected, and seeing that inflation is slowing and putting a 0 in the report for October means well for future reports, because they typically look at trailing 12 months, and having a 0 in there is going to help future readings as well. So that was the main part. A second maybe observation, something we talked about with Treasury issuance, how the Treasury had a lot of treasuries to issue, and reports were that the issuance was pushing up yields, and that's what people call market technicals. So Treasury yields were moving, not in fundamentals. Fundamentals are what an economist or an investment professional would sit down with a calculator and say, what should this instrument yield? But technicals are more, I don't care what you think it should yield. We're issuing $100 billion today, and there's not enough buyers, so the price goes up, or the yield goes up, excuse me. And disruptions due to market technicals can resolve themselves quickly. Because it's more of an anomaly. It's something that's not fundamentally supported by definition. And I think we saw some of that as well, that yields were in fact higher due to the issuance, due to the technicals, and that got resolved. So we saw a pretty big decline in Treasury yields as the 10-year Treasury now is down to about 4.25, and it was 5% just about 45 days ago.
So we had a guest on in the September 21st Wealthy Behavior podcast, a primer on mortgage-backed securities, a portfolio manager from DoubleLine, who talked about the expectation that he was seeing that yields would back down after Thanksgiving, as I think it was Silicon Valley Bank maybe was unwinding parts of their bond portfolio. Am I remembering that correctly, Bob?
Yeah, you're right. He made the call that rates would be lower around Thanksgiving. And, the market never issues a memo saying exactly why. So in the face of it, I think we could say he got the call right. Now, was his reasoning from Silicon Valley Bank's liquidation running out versus other macro factors? What drove it? Not sure, maybe both. But yeah, he made the call that rates would be lower, and mortgage rates are down to about 7% now, and they peaked around 8%.
So you said that the impetus may have been good inflation numbers because, good inflation allows the Fed to, either not hike or maybe at some point in the future cut. And we had been worried about sticky inflation a couple of months ago, or at least the market was. Where are your thoughts now on a recession for next year?
Yeah, so to put a little more on that, you can make forecasts, look into a crystal ball, or you can look at market data. And looking at market data is what we prefer to do. So looking at Fed fund futures implied rates in 2024, there's been a big change. So this is what like market participants are making investments, putting money on where they think rates will be. And so we look at that and say that that's what the market's expecting. And it's shifted pretty dramatically over the last month. So that now rate increases are not priced in at all. So the market is saying the Fed is done raising rates, and the amount of cuts has been increasing, so that now we're at about, by the end of 2024, the futures implied Fed funds rate is about 1.3% lower than current levels. So the base case that the market is telling us is there will be 5 rate cuts next year. And Chairman Powell has been seeing this and has been made a statement, I think, on Friday, reiterating the more hawkish tone that, we're looking at inflation, core PCE is 3.5%. That's not 2. We're not there yet. Hikes are still on the table. So he's definitely not talking about the pivot or telling markets you're right. So that there's a little bit of kind of headbutting from what the Fed is saying and what the market's pricing, which is common. But so the question of recession, when you look at the market and the market's saying the Fed's going to cut over 1% next year, well, why would they do that? That's probably the market pricing in rate cuts due to a recession. Now, where it gets a little complicated is you could say, okay, let's say the market's right and call it about a 1.25 rate cut is priced in next year. It's not the way it works is not saying there's a 100% chance that they're going to cut by 1.25% next year. It could be, to keep the math simple, a 50% chance that they do nothing next year and a 50% chance that they cut by 2.5% next year. And that gets you to a weighted average probability of 1.25 rate cut next year. And with the Fed funds rate at the 5.25 to 5.5 range, there's a lot of room for them to cut. So the market is pricing in some chance of rate cuts next year, but how it exactly weighs out, no one knows. Other than I would just acknowledge that there is, as there always is, meaningful risk in markets, and we should be aware that recession could be in the cards next year, but probably not a base case. I wouldn't go that far.
Because of how you walked us through the probabilities?
Correct.
Yeah. So back to Powell for a second. Do you think that he is, because we saw this tug of war before where Powell had talked about, we're going to do this. And I think at that point it was, rate hikes, and pretty aggressive rate hikes. We're going to be extremely hawkish. We don't care if we break things along the way. And a lot of market participants seem to doubt the sincerity of that. Do you think that's going on now? Or do you think Powell's doing something which we've also seen where it's just trying to verbally slow things down, or whether or not he actually means that he thinks hikes are still on the table? We don't know.
Yeah, I think it's more the latter. He's verbally trying to slow things down, and I wouldn't be surprised if we see more of that. He wants to be in control, and there might be a little bit of a feeling of he wants to be in control, and he doesn't want to surprise markets. And when the markets get too far away from where he wants to be, then you're setting up, he's setting himself up for a surprise. So I wouldn't be surprised if we see future hawkish rhetoric from him to try and get markets more in line with where he wants it to be. And, in his defense, we're not there yet. So, right. But markets are forward looking. So that is part of the challenge, where the Fed's looking at, trailing data that's coming in on inflation, and the market's kind of looking 6 months out.
I have felt the same way that you did, or at least was thinking along the same lines you were, when I was seeing all this commentary about, rate cuts next year, rates backing down next year. And if there's no recession, why would, rates be coming down? Why would they cut rates? Is it that clear cut, or are there other reasons that they may cut if maybe certain segments of the economy aren't doing as well, like housing, but we're not in a technical definition of a recession?
Yeah, definitely. I mean, the real soft landing would be they probably do cut rates a little bit, and just to keep economic growth, so that they see signs that the economy is slowing, but it's not in a recession. They cut rates by 1 or 2%, and it's enough to keep a healthy labor market. So that's definitely a possibility. That's really threading the needle, you could say. But there's the spectrum of different outcomes from the perfect soft landing where they get rates probably down to more normal, like 2 or 3% Fed funds level where they'd like them to be, versus the recession, and there's everywhere in between.
So what do you see in the bond market now, Bob, besides those rate expectations? Yields have backed down. It was a strong recovery for fixed income. What are you thinking about now when it comes to bonds?
Yeah, overall, they're still attractive, is our view. We're still seeing yields in the fours in treasuries, and spread assets higher. Long-term munis look attractive. So we have been increasing bonds, and still probably will be increasing a little bit more. So it's still an attractive bond market. I think there's room to go. We had one good month, but when you look at trailing returns, year to date, we were negative a month ago. So I think there's definitely more room for yields to fall in bonds over the next 1, 2, 3 years. It's a good setup for investors to be in bonds.
So the S&P recently made, I think, its high for the year, still a little bit below its former peak. What are you seeing in the international markets?
Yeah, international markets are participating, and their valuations are more attractive, and also performance is more balanced, you could say, in the U.S. market. A lot of the performance has come from the new name, I think, is the Magnificent Seven, like 7 big tech stocks that are up huge amounts year to date, and everything else is about flat. Whereas in international markets, you see much broader participation where like the median stock overseas is doing better than the median stock in the US. So we're seeing healthy returns overseas as well. So developed international has been doing better than emerging markets, but seeing good participation across regions. But just to read off some numbers, looking at the last 1 month, US was up 8.9%, world ex-US up 8.6%, and emerging markets up 7.4%. So very healthy 1 month returns across the board.
So getting back to rates for a second, Bob, we don't make rate projections in our, investment process, but you're aware of rates and they factor in somehow. Can you explain maybe to individual investors how interest rates and interest rate outlook matters to a chief investment officer?
Sure. So when we build portfolios, we use what we call capital market assumptions that are long-term in nature. So really 10-year return forecasts. And when you calculate the expected returns at the asset class level for bonds, the most accurate way to do it in looking at history is it's actually pretty simple. Well, big secret here. You look at the current yield. And if the yield's maturity on a 10-year treasury is 4%, well, there's a pretty good chance that you're going to get a 4% return on that instrument over the next 10 years. Stocks are a lot more complicated because they don't mature the way a bond does. And there's multiple expansion and contraction. So an index could trade at 20 times earnings today, and in 10 years, it could trade at 15 or 25 times earnings. And that would make a big difference in the future outcome. And then you also have earnings growth. So there's more variables, more uncertainty in the stock market. But for bonds, we basically look at the yield for intermediate term bonds. And right now the yields are pretty attractive, about near the highest level we've seen in the last 15 plus years. So on the face of it, those look good. And then in comparison, when you look at stocks, valuations are about average over that period. So you have, say, over the last 15 years, bond yields are the highest, whereas stock valuations are average. So this is called relative valuation. You're comparing the valuations of bonds, the valuations of stocks, and that kind of tilts the scale a little bit towards bonds because they're really attractive compared to history, and stocks are, just okay. So that's some high level perspective on how we think about these things.
Awesome. Thank you. And something maybe more actionable to the folks who have been sitting in cash or, 2-year treasuries or short-term CDs or high yield money markets. How does all that we've talked about, particularly around rates and expectations for next year and the fact that rates have backed down already, how does that impact those folks and what should they do?
Yeah, so I mean, just for example, in this is the last 1 month. In the month of November, the Bloomberg U.S. Aggregate Bond Index was up about 4.5% in a month. So that index is mostly treasuries and government agency mortgages like Fannie Mae, Freddie Mac, and investment grade corporate bonds. It's high quality intermediate term bonds. It's up 4.5% in a month. Even bonds can move in a big way. And the studies do show that when you have Fed rate hiking cycles and you have peak rates, it is a bit of a cash trap where you see, oh, I can get 5.25% on a money market or in T-bills. Why would I do anything else when I can just sit back and, the slang now is T-bill and chill. Just get the T-bills at 5.25% and do nothing. And that's great. Don't be greedy. But what history shows is most of the time you'll do much better buying on the more conservative end, bonds, intermediate term bonds, where you get price appreciation as rates normalize and decline, or stocks, which have a long history of outperforming cash. It's not common for cash to do better than stocks. So I'd use cash appropriately. And if you have big expenses coming up in the near term horizon, call it 12 months or less, cash is appropriate. But if it's long-term money, multi-generational money, it probably should not be stockpiled in cash. There's a spectrum of risk, and start with investment grade bonds, but also look to stocks because history shows us that the odds are definitely in favor of bonds and stocks outperforming cash.
Do you expect money market yields to back down soon?
Yes, that's priced into markets with that kind of goes hand in hand with seeing peak rates. Now, soon, not next month, but in the next 6 to 12 months, yes. And that's where when that starts to happen, then people will look around, and if the money market isn't yielding 5.25%, it's yielding 3%, then okay, this isn't as exciting anymore. What else is out there? At that point, the values that we're seeing now won't be on the table.
Got it. Okay. Yeah, that makes a lot of sense. And it's something we've touched on in prior episodes for sure. Anything else on your mind, Bob, about the investment universe you want folks to know about?
Maybe like a quick portfolio update. Something we've been busy doing is tax loss harvesting.
Mm-hmm.
I don't think we've talked about that on this podcast, and we do get some questions from clients about it. So I thought maybe we touch on it today. If
Yeah, go for it.
Yeah, so what we do is we comb through every holding in every account and look at positions that are at a loss for the year. And if positions are at a meaningful enough loss, we'll sell the security in a taxable account to book the loss to help the client with their taxes. So in bonds, we have thresholds. So for example, we might look at something like the loss needs to be at least 3% and $5,000. In stocks, so because stocks have more volatility, a higher threshold, something like a 10% loss and also $5,000. And we'll sell the security. You have to be out of it for 30 days to avoid the IRS wash sale rule. And then our intent is to get back into the position. And this helps clients out with their taxes so that we book losses. It can offset other activity, whether it's in their portfolio or in their life, if they're doing real estate deals or selling a business, or have gains from their portfolio from other positions. And sometimes we get questions from clients looking at positions and saying, why didn't you sell this position? I have a $3,000 loss there. And if it's, to use an example, like an emerging market fund that might be down, if it's, say it's a $100,000 position, it's down 3% and $3,000, we ordinarily would not sell that for a tax loss. And, the conversation goes, why not? That's a $3,000 loss. I could use that. The issue is, tax loss harvesting is not a free lunch. You do get the loss and you get to use it to offset gains, but the risk lies in the conduit. So if you sell the position and you take that $3,000, 3% loss, you buy something else. Well, in November, emerging markets were up 7%. So now your kind of backup funds, your plan B fund you own, and it has a 7% short-term gain. What do? We ordinarily would want to sell it and get back into our preferred fund. But if you do that, you just incurred a 7% short-term gain in exchange for a 3% loss. That doesn't make sense. So that risk of the market going up and causing a adverse tax action on the reversal is one of the things we look at. There's also transaction fees and also slippage from being in a different vehicle for a month. So different things we weigh, but we go through portfolios very diligently to help our clients where we can by taking losses for the year.
And that was done, usually early December, but it's also an ongoing thing, right? It can be done during the course of the year. It's not necessarily a year-end strategy.
Yeah, definitely through the course of the year. We did it a few weeks ago for most clients, and that was kind of a combination of getting near year end, but also that was near the bottom in bonds in particular, bottom in price or peak in yields. So we started to see some losses of the 3 to 4% range and took those. So it's both time and price driven, and we'll look again over the course of the year. So it's not just like a one-time thing. But yeah, that's tax loss harvesting in a nutshell.
Great. Thanks for that overview. Something that I wanted to touch on briefly was the sad news we got last week that Charlie Munger passed away. And I would encourage you to learn more about him and read some of what he's written and some of what's been written about him. But a brief overview. He died at 99. He was the vice chairman of Berkshire Hathaway. Fascinating life. He was a magna cum laude at Harvard Law without a college degree. He had joined the armed forces at the age of 19 in 1943 for obvious reasons. He ended up practicing law, was a partner in a law firm, did a lot of real estate development, and had his own investment partnership in the 60s and 70s. But he's best known for his long-term partnership with Warren Buffett and getting Buffett to expand his investment approach to not just buying dirt cheap companies, but great companies at a good price. But to me, he's so much more than an investor that you can learn from. His role model was Ben Franklin, and he talked a lot about the value of lifelong learning, reading across all disciplines. So, guys like you and me don't just read investment stuff, biology, psychology, chemistry, physics, read the source material, read biographies about those people, just constant lifelong learning through multiple disciplines, build checklists to use that knowledge. And he also, first I've heard of it, I'm sure he didn't create it, but this concept of inverting, which is turning a problem upside down and thinking about how not to do something, can help you unlock how to actually do it. So, I mentioned you should read about him, read some of what he's written, some suggestions or recommendations. Poor Charlie's Almanac is a book that he compiled. It's phenomenal. It's expensive, but it's great. Charlie Munger, The Complete Investor by Trent Griffin, and then Damn Right, Behind the Scenes with Berkshire Hathaway Billionaire Charlie Munger by Janet Lowe are 3 places you can get a head start. Thank you, Bob, and thank you for another great conversation about the investment universe right now. It's always good to talk after a nice month in the markets. Hopefully things stay at this pace, but if they don't, we will explain why and what you should be doing about it. So thanks again, Bob.
Thanks, Sammy.
Save the date for our annual Market Outlook webinar, where we'll share expectations for stock and bond markets in 2024. It'll take place live on Wednesday, January 17th at 12 p.m. Eastern. Have a question you want an answer to? Submit it during registration or ask it live during the webinar. A registration link is available in this episode's show notes and on the event page of our website, www.heritagefinancial.net. Can't make it? Register anyway, and we'll share the recording once available. Listening to this episode after the fact? You can find a recording of the webinar on our website.
Thank you for listening to Wealthy Behavior. If you found the conversation useful, please leave a review wherever you listen to your podcasts and share this episode so those around you can live a rich life too. We appreciate your feedback and questions. Please email us at wealthybehavior@heritagefinancial.net. For more insights, subscribe to our weekly blog at heritagefinancial.net and follow us on Facebook, Twitter, and LinkedIn. Check out my personal finance blog at thebostonadvisor.com. Wealthy Behavior is produced by Kristen Kastner and Michelle Kakanis.
This educational podcast is brought to you by Heritage Financial Services, LLC, located in the greater Boston area. The views and opinions expressed in this podcast or that of the speaker are subject to change and do not constitute investment advice or a recommendation regarding any specific product or security. There is no guarantee that any investment or strategy discussed will be successful or will achieve any particular level of results. Investing involves risks, including the potential loss of principal.